I'm Greg Liska with Iron Point Financial. Welcome back for Part 5, IRAs. So there are two IRAs that we're going to talk about here today, the traditional and the Roth. And they're actually pretty different from one another. So let's start with the traditional IRA. Actually, let's start with something that's common to both of them, and that's our contributions. Now, consult your tax advisor because there are specific rules if your income gets too high. But let's just pretend for our example, we're going to try to simplify things. Let's say we make $10,000 of income. I like the easy math anyway. So $10,000 of income, what are our contribution limits? And at that point, both of them, if you are younger than 50, the contribution allowed into a traditional or a Roth is $5,500. Now, if you're over 50, they'll give you an extra $1,000, call it a catch up, and bring that total to $6,500. Now, IRA in general stands for Individual Retirement Account. You will not have a joint IRA. There will be a Greg Liska IRA, and that's it. I mean, an individual is just one person on that account. A traditional IRA, it just has to deal with where the taxes are paid. So on the traditional side, here we make our $10,000. We pay, let's say we pay $100 in tax. Now, on a traditional, we put our contribution in pre-tax, okay? So we've got $10,000 of income. We're going to put $500 into our IRA. For federal tax, our income is now reduced to $9,500, okay? So we put that money in pre-tax on the federal tax side, okay? Now, I promise you, Uncle Sam did not forget that he did not tax that money, okay? He's just going to wait until that money grows, and let's pretend that we're going to take it out at age 65. There are special rules if you want to take it out prior to 59 and a half. Again, consult your tax advisor. There may be penalties that we have to deal with there, or there's different ways to do that and get around that. But let's just keep it simple. Pretend we're 65. We had $10,000 income. We put in $500. At 65, when we draw that money out, that's when it's taxed. And whatever amount we take out is taxed as ordinary income in that year. Okay, so just that year of, in the year in which we take that withdrawal, we're going to pay ordinary income tax on the traditional IRA. Now, let's compare and contrast that to the Roth. Again, $10,000, we're going to owe $100 in taxes. In a Roth IRA, we pay our tax first. Okay, so $10,000, we pay our tax, again, just focusing on the federal income tax. So we have $9,900 of income. Now that's income we could go buy milk and bread and eggs with, or we could take some of that and put it into a Roth IRA. Okay, so this is money we've already paid tax on. Again, fast forward until 65. We start taking money out. At that point, all that money is tax-free. Okay, so in a Roth, we pay the tax up front, federal tax, but we get our distributions tax-free. Versus a traditional where we get the tax break up front and the distributions are all taxable as ordinary income. Okay? So, which one is right for you? Well, we need to have that conversation. That's a little too specific for a broad video, but we're happy to have that conversation with you. We'll see you in the next video.